Okay. So here's a training on how to quote a rate and term refinance in Mortgage Coach. Okay, with kind of the most common ways to do it. So let's go back here, and another thing that I've learned recently that's cool for Mortgage Coach is this thing called strategy templates. So this allows you to create a quote a lot quicker. So normally in the past you would have hit new client, and typed in their name, right? What you can do now is go to strategy templates. Okay, and rate and term refinance. I can hit this, copy to new client. So we're going to call this Ryan and Tony training refi, right? Okay, so now that I've relabeled that, but you can see here, everything's already been populated. So now all of a sudden it is so much easier. We just have to basically, if you preview, kind of automatically populates with kind of already what was in there. Now, what we would want to do is edit this. So we go to client, goals. We always want lower interest rate. So if you are setting one up from the very beginning, just make sure you click that. Otherwise, it doesn't populate the numbers correctly. But then we enter in current property value. Typically what either I leave that blank or I'll put the number that they bought it for. I don't know what you do, Tony, on that. Oh, is that what you do? Yeah. Okay. Yeah, what you bought it for. Or is it okay, Zillow, right? Then you put in first payment date. So like if they closed in March of 2020, then I put here, right? Then we pull the original loan amount. You can either do that from the Encompass file. If they're a past customer. If they're not a past customer, you can usually get that from the mortgage statement or the credit report. Okay. So like when you get a credit report, I don't know, well, just I was going to do an example, but just pull up the credit report and then look at the original balance. It's usually in that line. So then we want to get the mortgage statement to put in the interest rate. And then usually this is going to auto populate from the original loan amount and the pay date, right? So then we'll leave this in here. Now, usually what I'll do is under the notes, oh, here we go, notes down here. So I will put assumptions. You don't have to necessarily do this up front, but it just down the road, what I typically do is I'll put initial payoff is 348,158. So this quote is based upon an estimated payoff. We'll have to order an actual payoff, and so that number will be changed down the road. So Ryan and Tony have been trained on that previously in terms of how to do an updated final quote to show them how that is different.
Yeah.
Now,
I would recommend though on the payoff or estimated balance, I would recommend comparing that with either the credit report balance or the mortgage statement that we've received. Because if either of those are higher, I think that would be a more conservative.
Probably more, more conservative.
With payoffs, there are going to
be.
Yeah,
I would agree with that. I think it's a very good point. I would say the decision would be go with the highest of the numbers.
Yeah.
Okay. So like look at the mortgage statement and look at the credit report. Whatever is higher, go with that. That'll be kind of the decision. Okay. Because I completely agree with you. It's better to be conservative. Then this is a good note here on this particular one. So this person has PMI. Now what is happening is if you look at the mortgage statement for Sarah Heimbach, which is the one that this guy and I got pulled from, the mortgage statement actually does not break it out. It just shows the escrow amount as 916. So what I want you to do is whenever possible, figure out what the PMI was. On this one, there's a past customer. So we just went to the original file, looked it up and got that. If we can't, I try to ask the customer what it is, okay? Because the reason I want to do that is then it actually calculates the savings correctly. So like when we're doing savings over 60 months, they wouldn't be paying PMI on the new loan, right? So in this loan, they have a rate at 3.75, but they also are paying $185 a month. So the overall savings by dropping the rate to 3.25, which is what I'm quoting her, is actually going to be even greater because we're not just saving on the base rate, we're also going to be removing the PMI on this scenario. So for what it's worth, from a training standpoint, if you're not able to get that broken out and you do think there's PMI, just make notes down here and I'll ask them for that. Okay. Then, yeah, so we just typed that stuff in, right? Any questions there?
No.
Okay. Then we go to 30-year fixed, right? So the thing that I want to note is if their credit score is not good, like a lot of times I like to put that in there because it helps me know, like when I'm quoting, like in this scenario, like 3.25, and they're like, hey, why is my rate a little higher than like the going rate right now is 3%? I can explain, oh, like it's because your FICO score is not 800, So if the credit score is like, I'd say below like 740, put the FICO in there, because then that way it helps him from a sales standpoint overcome that maybe immediate objection. Sometimes people throw at me like the rate looks high. Property value, you would update this. So like if, let's say this is a brand new file, a little tip I would say is, since this is actually, you're exactly right. So let's actually do, so let's update this because it would be a brand new file. So let's say it's 500,000. Let's say this is a brand new file and this person closed in 2019, right? So what you would do is pull from the mortgage statement, and then let's assume this loan amount is 400,000, just because it'll make it easier for you. Okay, so then we obviously go back here. Now I usually copy this if you want, but if you, another way to do that is hit the no and then yes, and it will automatically populate update. So that's a little tip, especially since we're going to be using the strategy template, since it's a copy and paste. Hit the no and then yes, and then it will refresh.
Now, what if we're trying to set up quotes where we like show them different options if it were appraised at different values? Let's say they're on the borderline.
So great question. So what I would say is let's finish out this, because this will be the standard, and then I'll kind of show you what that would look like, right? So just going through, y'all are now using the strategy template that shows you how to do it, right? You update it. Then we want to go to closing cost detail, right? So what's going to happen is typically I go to the Refi title calculator here, and we're going to enter in the new loan amount. Let's see here on this. What is the new loan amount? So the new loan amount's about 378, right? Okay, so we're going to type in 378 and make sure that obviously matches up. And then the payoff, like we discussed, go with what's, let's say on the credit report, it's 382. Okay, then they bought this home in 01 of 2019. So 1612 is the number that you would want to go with. It's normally 2437, but with what's called an R8 credit, it's 1612. So we're going to go back here. Credit report, actually, that should populate at 100. So that actually might be some money to save. But okay, so that also I'm going to start quoting $100 there. I feel like 150 was good, but like you can disclose it at 150 in Encompass, but I want to do 100 here in Mortgage Coach.
On purchase and refi, or?
Yeah, purchase and refi. And I've updated the templates already, so it should be. Then we hit 1612 there. Hit apply. Now, one thing we've learned is sometimes that does not save. So I would just open it back up and make sure it's saved. It's kind of an annoying thing. I am meeting with Mortgage Coach to see if I can get that glitch fixed. We quote the rate, right? So you would actually price it through Optimal Blue, enter in the rate and the points. Okay. We're usually going to quote between 0.5 and 1 point. That's kind of typically where we land when we're doing this. Now, the very first column, see it says match current escrow. We are literally just going to match the escrow account, but since there's no mortgage insurance, we'll delete that. Okay. Then this one, you would have just copied it over, basically. That's another tool you can use, but since this is a strategy template, it automatically populates it. So hopefully that makes things a little bit easier and not confusing. But actually, now that I think about it, I don't know, because you'd have to you're gonna have to copy it over. Yeah. So you hit that, then that way it copies from what you did in the first one, and y'all use the copy function, right? Okay, cool. So then we delete 731. Okay. And in this one, we would look up the taxes and insurance. So like, let's say it's 550 and 200 or something like that. Like, look, whatever the homeowner's insurance is based on the deck page and the property taxes from the county. I did those backwards. Thank you. Yeah. Were you about to bring it?
No.
Okay. So then now we have updated taxes and insurance. So if we go back here, we can show them, hey, the other thing too that I want to fix is I like to quote bringing in a payment to closing rather than $0 to closing. I know other teams do it different ways, but this is just the way that I typically do it. So now let's go back here. I want this number to show 2769. So here's how I fix that. Is I'll go to 30-year fixed, and we're off by $60. The math's pretty easy on this one. So I can decrease the loan amount by $60, and that usually fixes it. But then so loan amount decreased by $60 would be 424 minus 60 would be 364. Now that's usually my first way to revise it. And then, okay, then it landed perfectly. But let's say it gets you to like 368 and it's kind of annoying. A lot of times I will add and I'll go 101 right here. and get it to exactly the right number. So I don't know if you all do it that way, but like, I'm okay if you want to ever change a fee, like, because rather than going back and change the loan amount like 5 times, like, I find if I'm pretty close, I will just fix the credit report and put that figure at whatever it needed to get the cash to close to match. Okay, so updated taxes and insurance. Let's go back here. So again, like, we could do it right here. Or for example, I could just increase this to 160.
So you want it to match the
I-
payment.
yeah, I
Usually
want-
just ballpark it.
Yeah, that's exactly right. And what I do is I always, yeah. And the thing is I do it ballpark is like, the thing is I've never trained you how to do it. And I didn't want you like wasting a bunch of time when I can log in 3 minutes before the call and I can do it. So if you're
I
ever
think
like,
the way you
if you're
do it-
ever busy, you know, but like, see,
You
I
check
just,
all the fees and then you just adjust the loan
yeah,
amount.
so that's the way that I typically do it is I will either increase the credit report by the dollar amount to get you there, or I will decrease the loan amount or increase the loan amount to get you there. So whatever's easiest, as long as you can get close, I can just do it before I meet with them. But if you're not rushed for time and can take that extra step, it does make things a lot easier, because then it's just easy for me to explain to the customer like, hey, you know, we're going to close 30 to 45 days from now. Let's say we close on October, 31st. What'll happen is this is going to count as your November 1st payment, and then your first payment on the new mortgage will be December 1st. You don't have to do that. We can have you bring 0 to closing, but then it just raises the closing cost. Because the way that I typically sell these loans is I'll say, hey, here's this situation is that your current interest rate's 3.75. We're going to get you at 3.25. Then we're going to drop the PMI. Okay, so 2769 minus 2397, you're saving $372 a month. Okay. Now, in terms of closing costs, the way I've structured this loan is what is commonly referred to as a no-cost refinance. What people mean when they say that is we're rolling closing costs into the loan, so you're not paying it out of pocket. So a really quick, easy way to kind of basically calculate what you're paying in closing costs would be we're financing $4,300 in closing costs. Your loan amount's going up. So if we take the amount you're financing on the loan divided by how much you're saving, 372, your break-even point is 12 months. So as long as you stay in this mortgage for more than a year, this refinance makes sense. We'll scroll down here. Look, over 5 years, you save $12,000. I am quoting you where you bring a payment to closing. You can also structure this to where you would be bringing $0 to closing if you want to do that. But now your closing cost really that you're financing includes basically a payment, which would now mean you're going from $4,200 in closing costs to about more like $7,000. So it's really just a function of what you want to do. Most people are not doing a refinance because they want to skip a payment. They're doing a refinance because they want a lower interest rate and they want the lowest closing cost. So this is the way I set it up, but it's really up to you. So that's kind of a little bit of how I set it up. Does that make sense?
Mhm.
Okay. Then we go here. So then you can say, okay, hey, we updated your taxes and insurance, and you're paying, some of your savings is going to go away because your taxes are going up. So the other benefit of doing this refinance is it's going to help absorb the increase you would have gotten in property taxes. So your new payment in the mortgage is going to be $2,416. Okay. That's the first two options. Then what I want to do is we're going to roll in the new escrow account. And what we mean by doing that is you would need to be in Encompass. Let me see if I can actually log into a file. I'm realizing from a training standpoint, this would be easier if I was in a actual file. I'm bot. Did we?
No,
We never set it up, right?
well, she didn't let us. She didn't want us to
How did you?
credit,
So how did you calculate what to put for taxes and insurance 9 and 12?
Because I always get, well, taxes is straightforward, but insurance, as long as you get their insurance policy, you can calculate it.
Okay, so how do you calculate that?
So
To put,
Here's a little chart.
perfect. Okay, good. So
Yeah.
perfect. So you use the tax charts. Okay, good. So awesome. So
Yeah,
Tony
just a
Tony
general-
is using the training I sent out previously, which was how to do this as well. I've done a previous training on this. So there is a escrow chart. Let me see if I can find it real quick in my email.
just go based off the first payment date.
Here we go. Training. Boom. So there are these charts right here. So if you follow these charts, this helps. So there's also a training that you can get these stuff off the peak as well. Okay. So if you ever want to search, but this is kind of a little bit of a training. So, and then if you don't know how to determine when the homeowner's insurance is, you can look at it on the homeowner's insurance declaration page or the deed transfer date, because that would be the day they close. So we know that's when they would take over the homeowner's.
Interesting.
Think of that either.
Yeah. So for what it's worth, that's another way I find it. Like if I want to figure out when they have their owner, and then you just follow the chart. So like, for example, the
As long as they haven't refinanced prior, right? Because then the refinance might change.
it is, yeah, that there is chances they may have changed. Like, well, let's say also, what if they change homeowners insurance in the middle of the year? Like, let's say you closed on your house, what, like 4 months ago, something like that, but all of a sudden you decide to change your homeowner's insurance today. You just, well, then that would throw everything off. So it's a good rule of thumb. It's not always perfect, but hazard insurance first payment date. So like if I'm quoting this person on 9/16, we would have them close 30 days later in October. So their first payment is December. So December is the first payment. And then the renewal date, let's say in this August was August. So first payment's December, renewal is August. We would put 5 months
Okay.
right here for hazard insurance, right? Okay, then same thing goes for taxes, right? So taxes, you would pull up the tax chart, you'd look at the first payment. So I'll actually see if I can just pull it. Is there a quicker way for you to calculate, or you just use the chart, right?
I have the charts, yeah, I have it saved to my desktop. so
Oh,
I
perfect.
just
Okay,
look at
great.
it.
So, but when you're, if you've never read this chart before, you go to Texas. We would go to December's the first payment. And let's say.
To me, that's 13 months.
Yep, that's 13 months in December. Yep, which makes sense, right? Now, first payments, yeah. So we would, but I think we quoted Sarah when we set this up. We quoted her about 30 days ago, so that's probably why. So we put
Yeah.
13 months there. Okay.
Yeah, because she would, you know, if she moved forward, it was gonna close in like last month, I guess, or whatever. So
Yep. And so now what we've done is roll in new escrow account. Oh, shoot, I gotta go. Okay, so updated taxes and insurance. Okay, so we updated that. And then we just calculated 5 and 9. Okay. Entered that in, and now the loan amount has gone up, right? So the reason why that happened, and we'll wrap this up pretty quick, is we go to closing cost detail, hazard insurance reserves, tax reserves, added to loan amount. That's very important. These have to be clicked in order for that to do that. So now we can see the cash flow stayed pretty close, but the loan amount went up. Okay, which,
And you're okay with the cash flows being a little off?
well, it's off because if your prepaid interest days and
Right.
points being charged when the loan
Yep.
amount changes.
so what I would like to
Yeah.
do, if you have
Yeah.
time, is to
Adjust
go
it.
ahead, is to adjust that down. So,
Adjust
right,
that.
so 2769 or 2807 minus 2769 is $38. So you can do that in 2 ways. Number one, you just change the loan amount, or what I'll do is 100 minus 38. That's depending on whichever is faster, is 62. So, because I mean, it's gonna be fine because we don't typically charge more than 62 on anyway. So that's why putting it a little bit higher always helps. So then if I go back here, boom, now then it's ready to go. So I think we did strategy templates. Okay, because that's good. Oh, and then your question was like, hey, what if we want to run more scenarios, right? So let's say the appraised value came in higher. What I would then do is we probably add in a 4th column, and if you could fit it in the middle, but let's say appraised 85% LTV, right? Like, let's say this did not appraise enough to get rid of the PMI. So in this case, what I would do is say, okay, hey, let's change the appraisal, copy that. Let's say this only appraised at 400,000. Well, now what's going to happen is, okay, we're going to have to charge them for PMI. If you can stay between 90% LTV and 80% LTV, I like quoting single premium. If it's at 95 to 90 or 93 or whatever, then I would charge monthly PMI. And y'all pretty much know how to do that, right? So, so then what I would show is like, hey, if this doesn't appraise that much, I'm going to have to charge you, just for what it's worth. Let's say I'm going to have to charge you 100. Like now, all of a sudden, your savings gets eaten up. I'm still saving you some money because the interest rate's lower, and I'm saving you some money because the PMI is going down a little bit. But
with that quote, you don't want to use any of the escrow.
I mean, you could, we could do it like this, right? Like you could do 30-year fixed, current escrow, updated tax and insured, roll it in. But again, like I said, is I'm not always going to be going over this column. If I have time, I'm going to try and get them on board with that. But a lot of times I want to go over this.
Do it to match the first column.
Yes, that's exactly right. Cool. And so if you come back here, if you're setting up a refinance, you go to strategy templates, rate and term refinancing, you copy it over.
Yeah,
Okay.
that last option, I guess you would only need to set it up if they ask about it, but a lot of times, I mean.
Well, what if they tell you, because I always ask like, hey, what's